$1 trillion. That's how much home equity has been wiped out across just 12 American cities since the housing market peaked in May of 2022. And according to Cotality, formerly known as CoreLogic, the bleeding isn't done. Intercontinental exchange mortgage technology just reported the number of underwater mortgages in this country has nearly doubled in 12 months. Adam is reporting equity-rich properties have dropped from 49% to 44% in less than 2 years. Inside the 12 metros we're walking through today, the average homeowner has lost between $50,000 and $275,000 in equity, depending on which city they happen to live. That's why today we're ranking the 12 American cities where home equity just evaporated, sorted by dollar loss, smallest to largest. By the time we get to number 1, you're going to understand why even D.R. Horton's leadership went on its most recent earnings call and admitted, quote, Texas and Florida are not quite the powerhouses they once were. 3 things to watch for. First, the city sitting at number 1 isn't in Florida, isn't in Texas, and isn't anywhere most analysts have been telling you to look. Second, the one Texas metro where the current decline is already exceeded by nearly 3 times what the same city lost during the entire 2008 crash. And third, the Florida market where 27% of every mortgage written in the last 2 years is now underwater. Let's get into it. National home equity is at a record. The Federal Reserve Bank of St. Louis just reported total household real estate hit $52 trillion in Q4 2025. Owner's equity is sitting at $34 trillion. Read those numbers and you'd think everything is fine. No, it's not fine. What's happening is what Cotality's economists call a K-shaped market. In the Midwest and Northeast, prices are drifting up. But in Florida, Texas, parts of California, Arizona, Colorado, the Mountain West, homeowners are watching real money disappear from their balance sheets. The national underwater number is 2.1%, highest since early 2018. That sounds bad until you look at the metro data Intercontinental Exchange Mortgage Technology published in their February 2026 Mortgage Monitor. In Lakeland, Florida, that number isn't 2%, it's 10.8%. In Cape Coral, 10.1%. Austin, 9.2%. San Antonio, 8.8%. The national average is masking a regional catastrophe. If you bought in 2022, 23, or 24 in one of these 12 metros, your equity isn't theoretical. It's already gone. Even if you bought in 2015 with $300,000 in paper equity, the price your neighbor's house just sold for is the price your house is now worth. When a Punta Gorda waterfront home that sold for $985,000 in June of 2022 is now valued at $721,000, that's the new ceiling for everyone on the street. Number 12, New Orleans, Louisiana. Typical homeowner has lost $45,000 to $55,000 in equity since June of 2022, down 19%. What makes New Orleans different from every other city on this list? The driver isn't oversupply. It's insurance. The average annual home insurance premium in Louisiana is now over $11,000. Insurify projects another 27% increase this year. Louisiana ranks number 1 in America for seriously underwater mortgages at 10.7%, and the New Orleans Realtors Association reported 18% of pending sales were canceled, not because of price, not because of inspection, but because buyers couldn't get insurance. When insurance breaks, equity follows. Number 11, Phoenix, Arizona. About $50,000 in equity loss per typical home, down 10% from peak. In the 2008 crash, Phoenix lost roughly 50% peak to trough. This time, 10. Either Phoenix is just getting started or, as Cotality's chief economist Selma Hepp has been signaling, this is what the modern correction looks like in markets that learned from 2008. Tighter lending, slower bleed. Number 10, Denver, Colorado. $55,000 to $70,000 in equity loss per typical home. Here's your screenshot moment. Cotality reported in February that Denver led the entire country in year-over-year price declines on the S&P Cotality Case-Shiller Index, beating Tampa, Seattle, and Phoenix. A Denver homeowner named Radley Valentine told CBS Colorado, quote, "This is the first time I've ever lost money on a house, ever in my whole life." He has owned 12 homes. Number 9, Honolulu, Hawaii. $70,000 to $85,000 in equity loss, down 4% from peak. Small percentage, brutal dollar number because the starting price is so high. Maui wildfires, hurricane risk, aging condo infrastructure, same insurance pattern. Number 8, Washington, D.C., $80,000 to $95,000 in equity loss, down 12% from June 2022. Cotality reported that inventory in Greater D.C. spiked 60% year over year, the largest single metro inventory surge they've ever recorded. Driver, federal sector layoffs, and the late 2025 government shutdown. The federal worker who bought in 2022 watching their down payment vanish. Number 7, Naples, Marco Island, Florida. $85,000 to $100,000 in equity loss, down 9% year over year. February 2026 was the largest single-month year-over-year drop of any market in the country. Quarterly sales volume down 18%. HOA fees on a typical condo running $550 a month. And the Surfside Reserve mandates, Florida's law requiring condo associations to fully fund structural reserves, has triggered special assessments of up to $400,000 per unit at older buildings in Aventura and North Miami. That's not a typo. $400,000 in special assessments per unit on a condo someone already owns. Quick break. If you're still watching, do us a favor. Hit subscribe and tap the bell. The rankings get worse from here, and we're putting out a follow-up next week breaking down which states are facing the biggest property tax shocks of 2026, including the 3 Florida counties that just reassessed at the peak. Number 6, Cape Coral, Fort Myers. About $92,000 in equity loss per typical home, down nearly 19% from the July 2022 peak. The Cape Coral Metro has roughly 330,000 owner-occupied housing units. Multiply by 92,000. That's $30 billion in aggregate equity. Gone from this single metro since 2022. But wait, it gets worse. That's my best game show voice. That's just single family. The Cape Coral condo market is down 32% from peak, according to Wolf Street. Condo prices are sitting below October 2005 levels. Below. The typical Cape Coral condo owner is in worse shape today than they were the year before the housing crash that defined a generation. Remember that 27% number from The Hook? 27% of every mortgage originated in Cape Coral in 2023 and 24 is now underwater. Among FHA loans of those vintage, over a third. Real families, real down payments, real negative equity. Right now. Number 5, Northport, Sarasota, Bradenton. $95,000 to $110,000 in equity loss. Down 17% from peak. Year-over-year decline of 7.5%. Third worst in the nation. A real example, a single-family home in Venice, Florida, purchased for $565,000 in 2023, sold last December for $455,000, a $110,000 loss. Not a flip, not an investor, a homeowner who took a loss bigger than most Americans' annual income in 3 years. Number 4, Punta Gorda, Florida. $130,000 to $140,000 in equity loss per typical home, down 25.3% from the July 2022 peak. The largest year-over-year decline in the country at the time of recording, 11.93%. According to Redfin, drawing on First Street Foundation data, 99% of Punta Gorda properties are at risk of severe flooding over the next 30 years. 99%. The same waterfront home from earlier, the one that sold for $985,000 in June of 2022, just listed in March of 2026 for $899,000 after 6 price cuts. Bank of America's automated valuation model put the home's actual value at $721,000, a $264,000 gap between what the owner paid and what the bank thinks it's worth. That's not a market correction, that's climate repricing, happening in real time on every barrier island and flood zone in Florida. Number 3 is Austin, Round Rock, San Marcos, Texas. The typical Austin home has lost roughly $130,000 in equity since June 2022. The metro's median sold price has fallen from $550,000 in 2022 to $440,000 in April 2026, a 23.6% decline. Here is the comparison that should stop every Austin homeowner cold. In the entire 2008 crash, the worst housing collapse since the Great Depression, Austin lost about 8.5% of its home values, peak to trough. The current correction is already nearly 3 times that. Read that again. Austin's pandemic correction is already worse by a factor of nearly 3 than the 2008 crash was for that same city. Here is the controversial take. Austin isn't crashing because of a recession. There's no recession yet. Austin is crashing because Austin priced itself into a fantasy. From 2020 to 22, Austin home prices spiked 62%, while local incomes grew under 20%. The math doesn't survive contact with reality. The moment mortgage rates broke past 6%, the fantasy unwound. Anyone telling you Austin is going to bounce back in 2026 is selling you something. The Metro has 6.5 months of MLS supply, a decade high. Lennar told investors on its Q1 fiscal 2026 earnings call, quoting Stuart Miller, that incentives in Florida and Texas are running 14% of the sales price. Normal is 4 to 6. Austin will not stabilize until those incentives normalize, which means more downside, probably another 5 to 10%. Sellers who bought before 2020 still have equity to protect. Sellers who bought in 2021 or 22 have a decision. Cut the loss now or watch it widen. If that take got you fired up, agree, disagree, somewhere in between, drop a comment below. We read every one. Hit that like button too if this is the kind of unfiltered analysis you want more of. The more this video moves, the more people get to hear data their realtor isn't going to tell them. Number 2, San Francisco. The city itself, not the broader Bay Area. About $150,000 to $170,000 in equity loss per typical home, down 11% from the May 2022 peak. San Francisco is strange. The headline city number was actually up 5% year over year in March 2026. Sounds like a recovery. It's not. It's what Wolf Richter at Wolf Street calls the AI mansion shortage. A small group of newly minted, very highly paid AI engineers bidding up scarce trophy homes. That pulls the median up. Meanwhile, mid-tier homes, the kind regular families would buy, are still down double digits. The average is lying. If you own a $5 million Pacific Heights mansion, you're fine. If you own a normal home in a normal neighborhood, you've lost real money. Which brings us to number 1. The American city where typical homeowners have lost more equity in dollar terms than in any other major metro in this country. Oakland, California. The typical Oakland home has lost between $265,000 and $275,000 in equity since May of 2022, down 25%. The mid-tier home value index just hit its lowest reading since October of 2017. Meaning Oakland prices have given back 9 years of appreciation in less than 4 years. A single Oakland listing flagged by Resi Club in early 2026. House first sold for $4.1 million in 2022, just relisted at $2.5. A $1.6 million haircut on a single property. Why Oakland? Well, tech employment retrenchment in the East Bay specifically, most of the AI hiring happened across the bridge in San Francisco. Public safety perception issues, a glut of luxury condos nobody wants. Bay Area buyers who would have moved up to Oakland are leaving California entirely. A high-priced housing market with weakening demand fundamentals has produced the largest dollar equity losses of any major American city in this cycle. And almost nobody is talking about it. All right, let's bring it on home. What does this mean depending on where you sit right now? If you bought before 2020, you're still up, substantially up. Don't panic. Your equity cushion is real. But the comps on your street are now being set by people who bought in 2022 and are selling at a loss. Your paper wealth has been reset whether you sell or not. If you bought in 2022, 23, or 24 in any of these markets, Austin, Cape Coral, Punta Gorda, Naples, Sarasota, Oakland, Denver, your equity is functionally zero or negative. Refinancing is a problem. Selling means bringing cash to closing. Here's the math. A $400,000 home bought at 6.3% costs $2,500 a month in principal and interest. The same house at the 3.5% rate buyers were getting in 2021 cost $1,800. That $700 gap is exactly why prices had to fall. If you're a buyer right now, this is the best window in 3 years to negotiate. Builders are paying mortgage buy-downs in 73% of D.R. Horton closings. Sellers are cutting prices 6 and 7 times before getting an offer. Inventory is at multi-year highs in every metro on this list. If you're a seller and you don't have to sell, wait. Or understand that the price your neighbor got 2 years ago is not the price you'll get this year. The slowest motion real estate event in modern American history is what's happening right now. That's the phrase to remember. Not a crash, not a bubble pop, a slow grinding correction that started in the most overheated markets and is spreading outward, one zip code at a time. The data from Cotality, from Intercontinental Exchange Mortgage Technology, from Adam, from Zillow, all of it points to a multi-year rebalancing that ends only when prices, incomes, and mortgage rates make sense to each other again. That's where we are. That's what $1 trillion in evaporated equity actually looks like on the ground. If this gave you a clearer picture of where the housing market actually stands in 2026, do 3 things right now. Subscribe so you don't miss what's coming next. Hit the bell so you actually see it. And drop a comment with the city you're watching. We're building the data file for the next video around audience requests. Speaking of which, next week we're publishing the rankings of the 5 metros Cotality just flagged as the highest risk markets in America for 2026. The list will definitely surprise you. Until next time, keep your feet on the ground and keep reaching for the stars, or whatever. We'll see you in the next one.